So Chinese Premier Xi Jinping arrives in San Francisco, and apparently everything is solved. Or is that what's going on in Chinese markets and why they're sailing higher? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And our focus is going to be China, where there's been a really impressive rebound in local assets, as though things are improving, at least as far as investors are concerned, after a very, very challenging and very disappointing year. So the question on our mind here is going to be, what's going on? Why are investors suddenly enthused about buying Chinese stocks? And does this have legs, or is this one of those flash in the pan situations without follow-through potential? So let's start the conversation here with a look at what's actually going on. So this is a weekly chart of FXI. That's the iShares large cap ETF of Chinese stocks. It tracks the FTSE A50, which picks out the largest and most impactful 50 stocks listed in Shanghai and Shenzhen, the two big bourses on the Chinese mainland. It's also, incidentally, very closely correlated with HSI, the Hang Seng Index, which is the Hong Kong securitized stock benchmark, although FTSE A50 is the formal kind of underlying for the ETF. And we can see here, essentially, that we're on pace for a 6% rise this week. Now, there's still a few days left, but as it stands now, we're looking at a rise of nearly 6%, which already would amount to the biggest weekly rise in 4 months. Now, naturally, the question is, well, what's going on here? Why are investors suddenly wanting to buy Chinese stocks? The data that came out so far this week was admittedly a little bit better than expected. So first, we got a bit of positive news on industrial production, 4.6% rise year over year in October compared with 4.5% expected. A more robust still story for retail sales that was released at the same time. And there the increase 7.6% year on year. That's much better than the 7% expected. So positive news here, with domestic demand seemingly doing a bit better than external. That jives with the trade numbers that we saw earlier this month. There you can see imports having a much more meaningful recovery. Exports still kind of anemic here, down 6.4%, but imports popping back into positive territory, up 3%. That, of course, comports with retail sales looking better here than industrial production, which tends to focus on the external sector. But the sort of flow of information seemingly suggesting maybe something is stirring in the economy, and it's tempting to get optimistic. But before we do all that, let's remember China's economy is near standstill. This is the composite PMI data out of both the government, that's the CFLP there. That's data that's official out of the authorities in Beijing. The other one in the dotted line is the Caixin and S&P Global version of the same data. These are composite PMI indices, so they include both manufacturing and the service sector. And they're painting a very similar story. Now, as ever, PMI numbers work on a logic where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. You can see here the story in spades. So the bottom on the PMI numbers is right around December of last year. That's where the reopening from COVID restrictions occurs. There is then a surge. It's mostly powered by services. It peters out come the end of the first quarter, and then there is rapid deceleration. And we can see, if you look at the Caixin numbers, the economy is basically stalling. It's not growing or shrinking. It's stuck. If you look at the official numbers, it's growing at a snail's pace. So the situation in China is by no means good from a growth perspective. And indeed, when we look at the latest CPI numbers, again, that just came out this month, and indeed wholesale inflation, PPI numbers, they're negative. So they are once again telling us that demand is anemic. Now, this ought to be fairly straightforward. When people want stuff and they go and want to buy stuff, the price of stuff goes up. The more people want to buy it, the more they compete to get a certain amount of it. And that competition takes the form of bidding up the price. The scarcer something is relative to how much demand there is, and the greater that demand is relative to any sort of baseline amount of goods and services, the faster the price goes up. Well, when the price falls, it's the flip side scenario. Things go on discount. Nobody wants stuff, and so the price has to be slashed in order to get them to buy it. So this is still very much speaking to an anemic economy without significant demand. Even just looking at the third quarter GDP numbers here, we can see for the second consecutive quarter, we have the very unusual situation here where real GDP is actually higher than nominal GDP. Now, let's unpack this for a second. Nominal GDP is the value of all the goods and services made in the economy. Real GDP is all of that value minus the impact of inflation. In other words, if you add up the value of all the goods and services, but then you take away whatever value is tacked on there because the prices of the goods and services themselves have gone up, then you get the true sort of output measure or growth in output of the economy, minus a price effect. This is telling us that real GDP, which again is nominal minus inflation, is actually higher than nominal, which means that the inflation we're subtracting here is negative. And it's negative to the tune of 1.4% for the implied deflationary gap between these two, if we look at the past 2 quarters. That isn't just an economy with slight deflation. That is an economy-wide collapse in demand. So China's economy, from an economic perspective, continues to look awful. And so when we look at these numbers here that come in a little bit better than expected, what we're seeing is, in effect, percent change improvements when we compare relative to last year's atrocious conditions in the second half of the year. Indeed, things got so bad in China, the lockdowns got so punishing that there were a wave of civil disobedience actions. There was a wave of protests sweeping the country, and Beijing ultimately had to relent, and in December scrap zero COVID lockdowns and reopen. Now, these numbers here, this is October data. So this is 2 months before reopening begins. So we're just in these numbers comparing relative to some of the darkest economic period from last year. So it's not surprising that these numbers are showing signs of life, but they are year-on-year comparisons. And so relative to how bad things were last year, it's not surprising they're looking a little bit higher. But in actual demand terms, China's economy is in dire shape. And yet, that has not prevented investors from adopting a more positive disposition. We can see here, foreign currency deposits in China have actually increased in the latest data, which is quite the departure here. So we got a slight uptick in October. That's the first one since March. So for 7 months, money has been pouring out of China. Foreign capital has been pouring out of China. And in October, it cautiously returned. Now, in the gray bars here, you see the year-on-year rate at which this is moving. So foreign currency deposits, again, compared year-on-year with the preceding period 12 months before. And we can see that foreign currency deposits are certainly still down relative to the prior year, but the degree to which they're down has been becoming smaller. In fact, for October, it was down 9.2%, which is the first single-digit reading on this measure since August of 2022, so over a year ago. So what we're looking at here is investors seemingly saying, wait a minute. It's the same story if we look at how the yuan has been performing recently. In the orange is the expected daily fix, the daily exchange rate set for benchmarking transactions. Obviously, when you look at versions of the yuan, and there's many of them, there's the offshore version and the onshore version, the free-floating version, the not free-floating version, the pegged one, the non-deliverable forward version. Lots of Chinese exchange rates, but when you look at the benchmark daily fixing for the exchange rate, the one that's used to benchmark financial assets and benchmark daily physical exchange, when you look at that and you say the orange line is what analysts expect on a given day, the red one is the actual fix, you can see that over the course of the third quarter, as things got really hairy with outflow out of China's economy, you started to see a really dramatic disparity. You can see that in that gray spread. Well, at this point, we've erased 3/4 of that disparity, largely because expectations, the orange line there, has come in, suggesting that the markets are getting less negative about their perception of the yuan. So capital outflow pressure is easing. So for the first time in months, we get a pickup in foreign currency deposits. Outflow pressure on the yuan is 3/4 unraveled from its peak. What exactly is going on? Why is it that even though the economy is in abysmal shape, why is it that investors are turning cheerier? Well, if we take a look here at the way that economic data out of China has been performing relative to forecasts, we start to see perhaps what is occurring. Markets are, as ever, forward-looking. They don't so much care if things are good or bad. They care about if things are as expected, better than expected, or worse than expected. Really, different than expected or not different. And what we see here is that from about the middle of July, economic data out of China, terrible though it has been, has cautiously become less bad relative to expectations, and as of recently has actually started to get outright better than expected. Again, that does not mean good. It just means better than expected. Now, it's very telling that right in the second half of July, so right as this begins to recover, what we see from a survey of economists by Bloomberg is we finally start to see a sort of pointed throwing in of the towel on Chinese growth expectations. Analysts are rapidly starting to mark down Chinese economic growth expectations for both this year and next, right around the middle and the second half of July. That's exactly what we seem to be seeing when this data starts to perform better, again, in relative terms, compared with expectations. It's not necessarily that the data is getting good or economic conditions are getting good, is that the expectations have been pulled down so significantly that the realized data outcomes are having an easier time coming in better than those expectations. So market analysts seem to have overshot a bit on just how negative their forecasts for Chinese economy performance look at this point. And as we say, markets are forward-looking. If they've already priced in a dire scenario, if all of the negative things we've just said about Chinese demand are already in the price, well, then there's probably not very much more to do to keep selling. And so now the question becomes, well, if there is a catalyst to keep selling, then things have to be worse than is already priced in. Again, not good, not bad, just worse. And what this seems to suggest is that things aren't getting worse. They're getting, in relative terms, less worse, as it were. They're getting marginally better against a set of expectations that is generally abysmal. And with that in mind, we have here a situation where there is some scope for bargain hunting. Now, if we look at the way Chinese markets have performed relative to U.S. counterparts, there is no shock here. They've underperformed by a long mile. The more sort of broad X-Trackers Harvest CSI 300 ETF, that's ticker ASHR, it's essentially the catch-all for the Shenzhen and Shanghai composites. It's 300 shares. It's basically a sort of S&P 500 equivalent type of index. It's down 10% since the beginning of the year. Obviously, lots of high hopes when the reopening occurred that the world's second largest economy would come roaring back, and clearly it has not, for a whole host of reasons. Of course, we've explained many times on Macro Money here that the reason why China's recovery, as we saw here with the PMI numbers, why there was that very short-lived pop and then everything fizzled, really speaks to you got to run up in services because you unlocked the world's largest population out of quarantine and essentially let them travel, let them partake of restaurants and concerts and various kind of in-person, face-to-face services. So there was an understandable pop there of pent-up demand. But by the time China reopened in December of last year, its main external customers had not only spent a year and a half diversifying away from their China-related supply chains, because, of course, they'd started to reopen sooner and China was still closed, and so something had to be done to get goods over in a more predictable way and to deal with the significant inflation that came from supply chains being hampered, in large part because so many of them ran through China that was closed for a year and a half longer than everybody else. But the growth in those key export markets had peaked back in 2021, toward the middle of the year. A little bit earlier if it's the US, a little bit later if it's Europe. But no surprise, China, as the sort of quintessential value add node in the middle of the global supply chain, where raw materials come in, abundant labor is applied to getting those raw materials and semi-finished goods more finished or fully finished, and then shipping them on to developed markets where most of the consumers with the money live, be it North America or Western Europe. Those markets in North America and Western Europe had already seen their post-COVID catch-up growth peak and peter out in the first half of 2021, essentially. And of course, by that time, not only had stimulus started to wane fiscally, but central banks were already gearing up an aggressive rate hike campaign and making borrowing costs surge to deal with inflation. So by the time China rejoined or tried to rejoin the global supply chain late last year, demand was just not there like that. And so it's really not surprising that the growth, such as it has perked up a little, is perking up in terms of domestic demand. Because now, obviously, we are not in lockdown, and when we look back 12 months, we very much still were. So it's not surprising that we're seeing some notable pickup in year-on-year numbers for retail sales, for imports, all of these sort of domestic demand considerations. Meanwhile, the external sector remains anemic because demand just hasn't come back. So all of that very much holds. All of that remains. And so it's really no surprise that once the markets really kind of came to understand what is occurring, that Chinese stocks fizzled, because a lot of the optimism that people thought was maybe coming with China's reopening fundamentally didn't materialize in reality. And so that FXI large cap index that we were just looking at, the top 50 shares, that's down 7.2 on the year, and that's after the recent pop. The bigger, kind of broader CSI 300 still down 10. Now, obviously, the U.S. compares very favorably with this, even if we exclude the very buoyant tech names. Obviously, with the tech names, we're up almost 18%. Without them, we're down on the year, but only very modestly, 0.4%. If we look at the S&P 500 here as a kind of catch-all for Wall Street. So if things have stopped getting worse in China, if the stock of bad news is out, well, then here we have a set of downbeaten assets that have underperformed all year, and that perhaps finally have a bit of attraction for bargain hunters. Now, chasing the S&P 500 into the end of the year here certainly could be attractive, and we've seen explosive gains earlier this week, but bargains are difficult to find, surely, in a market that's up 17, almost 18% with all of the various issues abounding that we can see. But if the bad news out of the world's second largest economy has run dry, and things aren't good, they're just not getting any worse, well, then the repricing happens in the direction of shares going higher. Because the reality, though, again, it isn't good, looking at this is turning out marginally less bad than expected. And that, too, has scope to be repriced into assets. So perhaps what we're looking at into the end of the year here as a sort of shorter term view is a closing of some of this underperformance gap. Certainly not all of it. It's probably a tall order to suggest that we're going to see convergence here before year end. But to trim some of these losses into the end of the year seems like a plausible path of least resistance from here. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, where we try to unpack what happened on Wall Street on a given day and then attempt to figure out what might be next. I'm back on with Chris on Fridays for Futures Power Hour, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining sporadically on Twitter, or the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Good luck out there. See you tomorrow. Take care.